I got a loan from my insurance company and I'm paying back interest. But who gets the interest when I pay it back? Well, by the end of this video, we're going to know exactly who. My name is Darius.
And I'm Carmen. Before we jump into that, go ahead and subscribe to our YouTube channel and hit the notifications bell so you're notified when we post new videos.
Now, this concept of borrowing money from my whole life insurance policies, we've probably done 50 videos on this at this point. But I don't think
if you didn't get it this time, try to get it now.
But I don't think we ever talked about the interest and who gets the interest, because we say pay yourself back the interest. Well, before we jump into it, when you borrow from the life insurance company, you're borrowing cash value from the insurance company because you're using your policy as collateral.
Yes.
We said that. You have that part. But again, you're borrowing money from the insurance company so your money can sit and compound. So the interest that you pay, the 4% interest, goes back to the insurance company. It goes back to the insurance company.
Now, I want to preface, we're saying 4% interest because our personal policies are 4% interest if we get a loan. Mm-hmm. Yours might be 8. It might be different from ours. We're just using 4 as the bookmark for our personal policies. So right. You will pay a fee. Your fee may be different from ours depending on the insurance company you're working with.
Right. So if you borrow money from anybody, any business, they're going to charge you interest. And the insurance company is no different. The only difference is the insurance company is charging you simple interest, or the companies that we work with is charging you simple interest.
Yes.
So that means if you borrow $1,000 and you have to pay 4% on $1,000, you're going to pay $40. Mm-hmm. Now that's very good in comparison to some of the interest rates that we get from the bank. Now, the reason why I bring up the bank is because they work the exact same way. Their interest is just a little higher because you're borrowing their money. Now, the money that we borrow comes from a pool of funds that they're charging you access for. Again, there's no difference between the insurance company and the bank. The insurance company is charging you interest from a pool of funds that they have access to. The bank is charging you interest from a pool of funds that they have access to, like all of our deposits sit in the bank. Mm-hmm. Whenever we pay that money back, it goes back to the person that gave you the money or the business that gave you the money. In both cases, it's going to be the bank. Mm-hmm. Now, here's the difference when we say pay yourself back the interest. The conversation is you borrow money from the insurance company and it's at 4%. It's a low interest rate, but you're using it to pay for something like a car, which normally from the bank would be more interest. So you pay yourself back what you would pay to the bank. And when we say paying yourself back, we're talking about that difference, that arbitrage in between of how much it costs you to get that money, have access to that money, and the amount that you're actually paying, which is going back to you and growing your system.
Exactly. So let's put some numbers on the screen and we'll make it very simple that everybody can track along, right? So if I get a loan for $1,000, like Darius said, I'm going to be charged 4% for this example. Mm-hmm. So 4% simple interest of $1,000 is
$40.
Thank you, Darius. Now let's say I am using that loan to make more money, and you should always make more money than what it cost you at 4%. So let's say my interest rate is going to be simple interest at, let's just call it 8%, right? So 8% of $1,000 is
$80.
Thank you. So $40 is what it cost me to get access to my money. $80 is how much I made back. Simple equation, right? The difference is $40. 80 minus 40. That is the additional interest that you made by this transaction. Mm-hmm. Now, a lot of people say, Carmen, why would I even do this? It doesn't even make sense. Well, I made money. And I didn't have to do anything. And all I did was move money from this hand to this hand. And I made money. So all I want to do is return that money back, principal and interest to the insurance company. They will get $1,000 plus $40 for the fee. And that $40 difference that I am pocketing, I can actually put back into my life insurance policy in my additional paid up additions rider. And that $40 can earn compound interest and grow year after year after year. And what that does is allow me to have more cash value to utilize for more loans in the future.
Right. And a lot of times people, just to answer your question, why does this even make sense? Why would I pay myself back additional interest when I'm only being charged 4? The reason being is a lot of people aren't aware that you can actually borrow money from the insurance company.
Yeah.
So what they're thinking about is money that they borrow from the bank as an example. But only thing we're saying is to take that same action that you would if you were to borrow money from a bank, even though you're borrowing it from your insurance company, and that difference that you would have paid to the bank, keep it for yourself. Now, here's another question that we get. What if I pay back my loan early? What happens to that interest rate? So if I'm being charged 4% annual interest, simple interest on that $1,000, that's $40 per year. But let's say I pay that money back in 6 months. Well, it hasn't been outstanding long enough to get to that year, so I only pay half because it's only been outstanding for 6 months, and I still have another 6 months if I was to keep that policy outstanding. So I'm only going to pay $20.
Now, again, to preface, this depends on the insurance company, because we know some insurance companies take their interest up front as opposed to paying you, as opposed to billing you on your anniversary.
Right. And even if they take that money up front, you'll get credited your funds, the money back, because the contract says that it's simple interest, and they have to maintain that simple interest. So if you only have the money for 6 months and they take it up front, then you'll get credited back.
And this is all great information to know, because these are things that you don't know if you're not in the game yet. So with us talking about pay yourself interest, for us, we're already thinking about the interest that we're earning from getting a loan. We're banking on that arbitrage, that difference in which we'll be making that we know we can apply back to our system. And this isn't any different really from any investment strategy that you would do, right? I'm not saying invest with a life insurance policy or using...
Invest in a life insurance policy.
Yeah. I'm saying use the cash value to invest. But when we invest in real estate, at the end of the day, you need money. And sometimes you borrow that money because you don't want to use your money. And typically you always do that because you always use OPM. You're going to get OPM, other people's money, at a percentage. And if you're working with hard money, that could be north of 10%, above 10%, right? So
no, hard money is ridiculous, especially when it comes to real estate. Hard money is, at least when we were doing real estate, it was like 20-25%. That's why we
chop your heads off.
That's why we were in business.
Because of that interest.
Because of that interest.
Yeah. But the point that I want you to see is, like, at any investment opportunity, you're going to borrow money at a cost, and you have to pay the principal and interest back to the lender. Right? So don't look at this as a different opportunity or a different perspective. It's the same thing. You just have a relationship with the life insurance company. Right. And I feel like a lot of people try to twist this and flip this and make this all sorts of things. And it's not. And especially once you get into it and see the processes and understand it for yourself, you're like, oh, that's what they've been talking about this whole time?
Right.
Because sometimes education isn't understanding.
Yeah, you have to get on that bike to learn how to ride the bike. Are you looking for a life insurance policy specifically designed to help you accomplish your financial goals?
And if you have a policy, or if you're looking for more education, would you like to be a part of a community with like-minded individuals who are all using life insurance to accomplish their financial goals? If so, click on the link below. We would love for you to join the Wealth Nation Money School.
And just because we're on a topic, let's go through another scenario. Here's why you would, let's say you have a monthly payment. Here's why you would pay it back to the insurance company, because what that does is it reduces the amount of money that's outstanding.
Yes.
So it reduces your interest rate as you make payments on a monthly basis back to the insurance company. Yeah.
And one thing that you touched on, but I want to elaborate a little bit on, is if I kept that $1,000, like we were talking about in the example earlier, if I kept it outstanding, meaning if I didn't pay it within a year's time, and that $1,000 rolled over to 2 or 3 or 4 years, what would happen is you would continue to be charged that interest as long as the bill is outstanding. And it's going to be based off of the outstanding balance. So if you are paying it down, you're going to be paying 4% on the outstanding balance. And the thing to note is you always need to pay back your loans. You did not hear us say do not pay back your loans. The only thing that we are talking about is the life insurance company gives you flexibility to pay it back in your time frame. So they're not going to come to you like the bank and be like, it's the 10th, where's the money at? That's why you have to be really disciplined with the system, because you have to have the wherewithal and due diligence to make sure that you pay the loans back in a timely fashion.
Right. And it's not something, when you get a loan, it's not going to be reported to credit. So there's nothing that you have to worry about. Matter of fact, if you have horrible credit, it's still not going to make a difference. It's still going to give you access to that money because your collateral is money that they already have. So credit, bad credit, it doesn't matter. Now, going back to the money being outstanding, the reason why it's so important is because there's a cost to having money. There's always a cost to having money. The money that's sitting inside of your checking account that you're not using, there's a cost to it called inflation. So what you want to make sure that you do is always have a purpose for your money.
Yeah.
Don't borrow money from the insurance company just to have it and look at it because you have access to it. That money is costing you. It's costing you a simple interest, and they're going to charge you every single year. So if you don't have a purpose for it, don't just take money just to take money. Have a purpose for it to make more money. Your purpose is always to make more money or put yourself in a better financial position to pay off high interest debt so that high interest you can earn for yourself. Absolutely. High interest debt is the best when it comes to this concept because you're only charged 4%, and that 20%, 25% that you're being charged right now, maintaining those same minimum payments back to the insurance company, you get to keep the difference, and that adds up significantly.
That's what helps really grow this process and this whole banking concept, because of that extra interest that you are paying back into your system and allowing it to grow at the compounded rate. That's what changes the game, and that's why we always say pay yourself the interest, because either way, you're going to have to pay that fee. And if you are a decent banker, you are a good banker, you should put that extra interest into your policy so it can grow long term.
That's what Nelson Nash in his book, Becoming Your Own Banker, when he talks about stealing the peas, going out of the back door and not following the system. That's not following the system. Don't steal the peas going out the back door.
Nope, because it's
especially
not
your family.
Yeah, and then the policy becomes a burden because you're not using it properly.
So if you want more information on how this lifestyle banking thing works, then check out our next video where we talk about lifestyle banking or infinite banking and how to use this strategy.
And don't forget to own your own lifestyle.
Or someone else will.